In 2004, Shailesh Karwa and Sharad Dalmia decided to enter the office stationery market by founding Officedge India. After 3 years of operations, the company tied up with global stationery major Staples.com and Kishore Biyani's Future Group. The company was rebranded as Staples Future with a vision to become Staples' permanent footprint in India. Operating in the B2B space, Staples Future supplies everything from basic stationery to even office pantry services to over 1,000 large corporates via its e-commerce portal. Staples was expected to buy out Future Group's 39% in the company in 2012, as Future Group was looking to divest non-core businesses. Staples, however, changed its position earlier this year, allowing Future Group to increase its stake to 60%, while Karwa and Dalmia went on to buy a majority of the remaining 40%. With the reshuffle of the current stakeholders, Staples Future has been infused with $25 million and is currently debt-free. VCCircle caught up with the founders of Staples Future to understand how the three-way joint venture is operating in India and how the company plans to increase its stake in the $8 billion Indian stationery market.
Thank you guys for joining VCCircle TV in this interview. I want to get a perspective today on Staples Future. Now, Staples has been there in the country, we've heard the name, we've seen the shops, but I wanted to know today, what are the operations? Shailesh, you can tell me, what are the operations of Staples today in India?
Sure. So Staples today in India basically runs as predominantly really a B2B company, where we serve large and mid-sized enterprise in India for their office supplies needs. And the way we serve them is basically we have them consolidate their entire spend on office supplies, help them reduce their vendors in this particular category, help them to professionalize their ordering sort of experience, where we help them go online, create custom setups for them, and at the end of the month, after fulfilling all their office supplies requirements, we help them create an information pack which shows them their spend. So we basically help companies save monies on this category of spend, which is typically less visible and has a lot of maverick spend. So currently we are serving around 1,000 large enterprise companies, a lot of mid-market companies, all of them online on our Staples Link platform. It's also called the Staples Advantage platform. And we basically serve around 3,000 unique shipping codes in the country. And the good thing about it is it has great traction in that segment of customers.
What we want to know is today there are three players involved. You all as the founding entrepreneurs, there's also Staples and there's also the Future. What is the agreement between the three of you all?
So I think really where me and Shailesh came in was, honestly we got in the entire business idea, and we were Officedge earlier when we did a startup, and we started this B2B e-procurement platform. Thereon we had interest both from Staples, because they look at India as a sort of 20-year market for them. It's the third largest, sort of the top 5 office products markets in the world. Very high fragmentation and sort of low penetration for them. So Staples wanted to be in India, they needed local talent, they needed local management. I think where Future Group came in is, at the end, Staples also was looking for a strong sort of local entity to provide a lot of the support, whether it's on the infrastructure side, regulatory side, finance side. I think we operate as would typically they really look at coming in as investors. So we have a board where we get sort of strategic direction, our business plans, and then I think we are very grateful that it's great operational sort of freedom. We have a large team here, including a senior management team from different industries.
What is the total employee strength at this point?
We have around 300 associates within India. A lot of them are working really on the supply chain side. Some of them are really contracted. We try and work with
So to put it simple, Staples is giving you the brand name, Future is the financer, and you all are the guys doing the operation. Would it be fair to say that?
Fair to say that.
Future had about 39%, they increased it to 60%, and you all have pretty much the rest. So we're trying to figure out why did Staples back out of it, because they have convertible debentures, but there was reports that they would go and increase their stake and become the majority holder. What happened really there?
Sure. So firstly, Staples absolutely continues to retain a strategic interest in the company. They would have options to buy out the company. I think the overall thought process when we restructured the entire arrangement was that we wanted to make sure that the company and all the partners, it was Staples, it was Future Group, I think all of us want to make sure that when we run this company, we do not at a certain level of scale. And currently, I won't say that it's yet reached scale. We are a 200 crore company, but we want to make sure that it reaches enough scale to be then therefore run as a subsidiary of a Fortune 500 company.
Okay, what would that scale be?
And that scale, really to my mind, would be really
$100 million at
we
least.
want to be a $200 million company before we really want to run it like a subsidiary of a Fortune 500 company.
Okay.
To our mind, what really worked in this entire restructuring was really a win-win proposition.
Okay.
We really needed to, from Staples' perspective, obviously have the brand, so they have a vehicle in India to carry forward the business.
Yeah.
We have the best practices, an ability to source from Staples brand group within China. So that's the ability which Staples gives us. I think from a future group and our ability as Indian partners, we wanted to have the flexibility really to be able to have a strategy which is largely aligned globally, but we want to make sure that it has clear flavors locally, how Indian enterprises, mid-markets, small businesses operate. So we want to make sure that it's good for the business. So when we restructured, we had Staples winning this from a context of having the brand name, having having a vehicle to grow in India. And from the Indian partnership standpoint, we have the flexibility to grow this to a certain scale, and then from there on we see how it creates value for all the stakeholders.
In terms of expenditure, does the margin now for Staples or the royalty for Staples decrease, or does it remain the same? What is it?
So I think, see, we have the 20-year master franchisee across the delivery, retail and online business for Staples.
All right.
And I think it's a lesser known fact that Staples is the #2 e-commerce site in the world after Amazon. So they bring great expertise and strength there.
Yeah.
So that said, I think because of the master franchise, we do have a royalty set up with them. So nothing changes. I think what really changes, and even going back to your question on the deal and the structure, is I think in 2007 when we started, I think it was a new market for them. It was a new category for us in terms of future group and us. I think 5 years has given us a lot of insight as to what this market is, where this market can be. And what we try to structure now is thinking that 20-year term. So Staples wants to be in India, has a 20-year horizon, but I think they want to come in at the right time in terms of having direct ownership and having such a, at least it should be some size for them. For a $25 million company, I think we are yet very early days.
Tell me something about the supply chain as to how you all implemented it here. So are you all importing from Staples China, or is it have you created manufacturing here, or how does it really work?
So 90% of our product is procured locally. We go out to manufacturers and buy it from them. A lot of the international manufacturers now have set up shop. So your HPs, Canons, Xeroxes are all here. So we don't really need to go to a particular country to buy. Having said that, there is a component of purchase from China, particularly on, say, private label or on stationery and housekeeping, where we believe that the cost of production is competitive and you obviously have a margin opportunity out there.
What is the typical margin in this business on, let's say, an average sale?
So it would, and when Sharad spoke about, how we're going to progress from customer segments, so at the moment we operate on the large and mid-sized enterprises. Obviously there the bargaining power of these large enterprises is a little higher. So we would look at operating at that particular segment for office products, so anywhere between 16 to 18 percentage points on the gross margin. And then as you go down on the mid-market, it would range around 22 to 24. As you come down to small businesses, you range around 28 to 30, and when you go to micro and consumers, you would really go to 35 to 40 odd percent.
What is your take on the market really as far as stationery is concerned? One, we have seen the phenomenon in which we've seen a lot of foreign players come in and suddenly tie up or buy out, local players. The second thing is that the market is primarily very fragmented. I don't know honestly if you think that there is
fragmented.
Is there a demand really to have a one-stop shop for stationery in particular?
Absolutely. I think we
considering you can get most of your stationery in many of these mom and pop or smaller stores like that.
So whilst making sure that you have enough respect for the mom and pop traders, the small shops which are very entrepreneurial, very service oriented, we do believe that there is this really nice market which is growing very fast for organized players. And what the organized players bring to the table is definitely a lot more transparency in this entire category. We bring service levels which are calibrated in a sense that there are clear service level agreements and you serve basis those service level agreements. Most importantly, you cut down a lot of maverick spend, which happens in this particular category.
What would that mean?
And that maverick spend would mean that every time somebody needs stationery and housekeeping, because the category of spend is low involvement for any business, mid, small, large, it just happens, and nobody looks at that. And whilst and therefore it's maverick or invisible, that spend almost. We make it visible. We make it visible to businesses, making sure that they are ordering online, they have clear MIS of what their spend was by department, locations, cost centers within their organization, and that cuts out a lot of spend which was done in a maverick way. You just bought something and you.
So stationery is a sporadic spend.
We call it the 100 rupee pencil. Your pencil costs maybe 5 rupees, but when you put down the cost you incur to get that pencil on, it actually lands up being.
And that 100 rupee pencil is particularly true for enterprise and mid market, who it's unfortunate that even in India, a lot of times you're stuck with the rate mentality. So you'll spend a lot of people, a lot of buying processes to figure out the rate of a pencil. But very few organizations put in a system to control the spend per se. How much quantity am I consuming? And how you're buying.
Typically, a large corporate would spend how much in stationery in a year?
So from a white collar perspective, if you take up stationery, your housekeeping, your facilities, your break room is a big one within India. Everyone takes breaks, coffee, tea all the time. We would reckon.
Do you service that part also?
Yeah, we service everything which an office requires on a day-to-day basis.
Everything you can see.
So we would reckon that your stationery, your paper, your printing, your pantry, your break room, your facilities, all of that, per white collar worker, you would end up spending around 800 to 1,000 rupees per worker.
Per worker?
Yeah, per white collar worker. So when we look at even sizing up potential within a company, it's their white collar worker strength. And if there are say 5,000 people or 3,000 people working, you would typically multiply it with 800.
So with a large corporate, would you do it on? Would you have a contract with them? What would that contract look like?
So when
on average?
I think a contract would be typically our experiences again is change management, right? If I'm going into a an Infosys or an Accenture, 100,000 employees. Typically what they would say is, okay, let's go into a particular category and we create a catalog there which is online. We pretty much link up their entire sort of infrastructure in terms of facilities, who are the people who can order, what are their cost centers, the whole sort of finance around that. And then they would, start buying on a pre-decided catalog, which is again a big value add. We would standardize the products they buy. We would establish SLAs on delivery. And what we've noticed is that I think the proof in the pudding is when we go back to them and give them an MIS, which tells them that listen, this is what you bought, these are the different people who bought all these different things and what you potentially saved. And I think we are pretty confident that pretty much at every corporate we've gone, we'll end up saving anywhere between 15 and 20% of their spend. Now the challenge always is that the person buying thinks that okay, I was buying a stapler for 35 rupees and now I'm buying it for 38 rupees maybe from you. But that's not the point. The point is that how much were you spending in total? Because there was earlier no control, no information, no visibility.
What is the advantage of going to staples? If most of the orders and the stationery is being procured in India through local manufacturers, what is the advantage in terms of quality or in terms of pricing from any other?
No, when you say local, I think we are disintermediating in the supply chain. So typically, I would either go to the manufacturer, even a lot of the imports. Meaning we have over 40 factories in China exclusively working for staples globally. So I think eventually we are looking at scale economies for sure. But I think the big point really is what you see is what you get.
And if I were to say, look at both the players, the local player definitely brings service, he's fast. And we wouldn't deny that. He's fast because he's just much closer to the customer, and he has that ability to quickly reach the customer and show him. Where we come is really quality, transparency, savings which are tangible, economies of scale, because we do believe we are the Amazon of small businesses. So
is there typically a price advantage that you can offer?
Yeah, because
or does that really not matter?
At the end of the day, I
think we guarantee savings.
We guarantee savings.
Any office buying through our channel, the challenge may be that you don't even know how much you spent it.
Is it through management or by pricing?
No, but I would also, just the economies of scale is such that today I'm buying paper directly from the mill. I'll be buying post-it notes directly from 3M, I'll be buying my stationery from Camlin and Chorus directly, or a 3M directly. So we definitely disintermediated a lot of these so-called channels of distribution and basically connecting customers directly with manufacturers with just one single channel which connects them, adding value to them, which is Staples.
Let's talk in the intermediate, in say 5 years. What are your revenues today and what would you want to target in say 5 years?
Sure. So we would steer clear of providing, one big revenue number which we want to reach.
Was it 100 crores that I read on the media?
So our company is a 200 crore company overall at this point of time.
So the media reported 1,000. We don't know whether that number.
I didn't really know whether to gauge that or not. So it's a 200 crore company at this point.
At this point of time. What we are really chasing is obviously structurally good growth, and that growth means that you continue making sure that you're increasing your penetration within all the 1,000 enterprise customers which you signed up, and there are a lot of categories which we are yet want to mine and get it all out. We have a nice big mid-market sort of offering which are all businesses which have more than 100 to 500 white collar workers. So a great offering there which we are just starting to roll out across all the cities, and that's a lot of work.
Why? How much would you all be growing?
I think we've been growing consistently at around 30%. And I think
which is pretty healthy.
We believe it's very healthy. I think the bigger point to look at is the number. There's no number to chase because you're looking at a market which conservatively I would say is $8 or $10 billion in India. Now deeply fragmented. So obviously you can't say that the entire $8 or $10 billion is necessarily something we can go after.
But considering that you have circled yourself around the corporates and the large corporates, there must be a
figure. So much.
Yeah, but structurally we don't see ourselves having any issue in having a 28 to 35% growth rate compounded year on year over the next 10-15 years, because that's the size of the market which is there. So we don't see that.
I think when we see, we discuss even given Staples, we have visibility to some of their businesses. So Australia with its kind of population just serving enterprises, we have $1 billion business.
So at present, are you all servicing the entire country or is it only Southeast India? Because many of your corporates are large IT companies.
So we have a direct presence by way of our distribution centers in all the 9 cities which matter, where there is 75% of the office catchments, so-called office catchments which are there. So we serve Delhi NCR, which is Delhi, Noida, Gurgaon. In the north, we have Kolkata in the east, we have Bangalore, Chennai, Hyderabad in the south, we have Mumbai and Pune, now probably Ahmedabad in the west. We have our own distribution centers. We would sign up with the head office of the enterprise or the mid-market customer, roll out a contract across all their locations. And today we pretty much reach around 3,000 shipping addresses every month, unique shipping addresses every month. That number keeps growing. And those 3,000 shipping addresses are not necessarily only on these 9 cities, they're outside of these 9 cities, pretty much almost 100 towns and cities where we are reaching today.
So the company was in a lot of, a reasonable amount of debt when you all just started. Now post the restructuring of the shareholders, the company is debt free. But are you all generating enough cash flows to say expand or even do brand building or things, or is there a need to raise funds in the immediate future?
So I think a growth business like ours, meaning there is obviously going to be moments in time where we will need growth capital for the long term. I think we've been lucky in terms of both the sort of joint venture partners that we've had have great belief in the business, and we've been fairly well capitalized over term. I think even the debt was sort of an interim measure, and now we are behind that. So that's it. I think we're reasonably well capitalized for our growth. Needless to say, I think as we continue to grow and we want to invest further in infrastructure, and I think in our business infrastructure is much more important because that's what builds the brand. So me going and talking about the brand without having the infrastructure and the service levels in place doesn't matter.
The values in the supply chain. So that's really most of the investment where it will go in. Having said that, I think we'll also be very prudent on how we use our cash. So we have a nice cash hoard right now. We want to make sure that at the current size also, whilst we are growing.
How much is the reserve cash? How much reserve cash you have? Spare cash?
So that's in the private domain, but it's enough to make sure that we have, say, a nice medium-term plan.
I think we're very comfortable. I think we have a business
model. Let me put it to you in another way. For how long will that cash last?
I would say we're not like a typical e-commerce company where we're working on the 3-month and the 6-month.
We're not
I think we're comfortable. I think our target this year is that we reach sort of a reasonable scale that we're going to sort of break even. So all the investments, whether in terms of cash infusions for the future or what we have, goes into really building, the infrastructure back end for our future growth, and not really to fund, any sort of losses, so to say. So I think we're reasonably comfortable. I would say we're not.
We do well. Like the back end would be what, warehouses or manufacturing, or what type of investments for?
So so the two areas where or the 2 or 3 areas where most of the investment goes is, one clearly is on the supply chain, where you have both technology investments to make sure that your supply chain is better and better configured, to be able to reach out to more places on time in full. We call it the perfect order metric. So how do you increase your perfect order metric? By the use of technology at costs which are reasonable. Anybody can throw cash and have a nice perfect order metric, but you want to make sure that how do you get a nice perfect order metric at low reasonable cost. So that's one area where you continue to invest. I think the second area where we invest is also somewhere on our sales and marketing. We do have like a direct sales force where we reach out directly to customers, and they really carry our brand. So we have this investment on the marketing. And
what about delivery or logistics delivery?
Which is the supply chain investment.
There's an outbound. I think the big efficiency you see in a lot of the markets, whether it's office products or others, is going to be that today a lot of inefficiency in cost is because of the overall ecosystem. So whether I see on the supply side, or I see on the infrastructure, or I see on the outbound side, and I see that sort of overcoming, with a lot of the e-commerce players coming in.
Considering e-commerce is such a big thing with staples abroad, and e-commerce has been the big buzzword here, why have we not seen that gap being filled by staples in India?
I think we do it, but we I think chase a business model which makes money for stakeholders and us, and not necessarily the buzzword of the last 2 years.
You've seen all the B2C sort of e-commerce sites which have spent a lot of marketing dollars out there in acquiring customers, and not even retaining them.
Would that be another way of saying that it won't work?
No, not at all. I think what is e-commerce? I think we're e-commerce, right? All our enterprise customers are buying online through us. It's only that it's, in your words, it's sort of invitation only. We register you and then you can buy. So I think we already would be operating one of the largest e-commerce sites from a B2B perspective with throughput. I think it's just we want to open the pipe where we can serve those customers with the service level we would like, and there's value for them and us. I don't think
at cost which the customer would see value in as well.
We definitely are not going to be looking to buy sales.
Is there an opportunity to acquire any local business to help you in, say, supply chain or quality?
We do get opportunities, but we do also think that entrepreneurs out there have a really unreasonable sort of expectation on the kind of valuations which they think they should get. So we've looked at a lot of them, and we always feel it's not
greenfield is better.
That's
it. Again, if there's some interesting opportunity, one would be open, but we've been scanning, so nothing which is either on the IP side or somebody having a big customer base which is interesting to acquire. We've not really come across something which is very interesting. A couple which did, then we thought the price was not.
My last question to you is more from the entrepreneurial side. Now, clearly, the buying into the company was clearly, you're waiting for that big exit whenever it happens, but is that something, would you always want to be a part of the company operationally, or would you want to say, get a good exit and then retire happy?
I think there's a sort of, long road yet at the moment for us to achieve in terms of the market.
I personally think, as entrepreneurs, you should not have an exit mentality. Once of time, it definitely takes away focus from the business. From our perspective right now, it's extremely important for us to be focused on the business, make sure that our processes are getting more robust, more solid, creating more value for our customers at all points of time, and that's what we are passionate about right now.
Absolutely.
So,
I think it's a long way to go, so I don't think we're thinking that. I think we're looking at yet building this business. I think there's enough. We've done a lot of the hard work, and I think there's lots more to do, but I think we feel we're sitting in a good place. So,
alright. On that note, Shailesh and Sharad, nice talking to you. Thank you.
Thanks a lot. Thanks for the opportunity.
Bye-bye.